The B-Wave correction represents a specific structural breakdown where institutional size is built even as local trends appear to fail. Most retail participants identify this downward expansion as a signal of trend exhaustion or a full market reversal. From an algorithmic perspective, this price action functions as a mandatory liquidity refuel station. Quantitative telemetry allows us to observe the specific moment a sell-off stabilizes into a heavily backed institutional accumulation zone. Navigating the B-wave requires an understanding of the mechanical capital allocation required by large-scale funds. On this NASDAQ 100 layout, a fractional crash, frequently initiating breakout shorts at the lows. The B-wave refuel operational matrix clarifies the institutional reality of this phase. Large-scale capital allocation requires these pullbacks to fill orders. During this phase, raw price action provides a deceptive view of the market's underlying health. Beneath these red candles, a calculated institutional refueling protocol is actively managing order flow. Reacting to the velocity of the B-wave often results in entering the market on the opposite side of the institutional bid. Large institutions face a physical constraint. Their order size often exceeds the immediate liquidity available in the book. If a fund attempts to execute a 5,000 contract long position during a vertical upward impulse, they encounter the mechanics of slippage. Consuming the available thin liquidity at the top of the book pushes the execution price aggressively higher, away from the intended entry. This makes chasing vertical velocity mathematically inefficient for institutional portfolio management. Consequently, execution algorithms are programmed to suspend buying operations during these rapid price expansions. These funds require a downward price trajectory to access the high-volume wholesale liquidity pools needed to fill their blocks. The B-wave functions as a mathematical cooling phase, preventing execution slippage by allowing the market to rotate back into resting buy orders. The B-wave operational matrix defines the transition from passive accumulation to the active liquidation sweep. Algorithms do not wait for price to drift into generic support levels. They actively engineer a wholesale discount. They monitor high-visibility retail structures, such as the chassis B floor or the hourly 55 deep B core. Institutional limit orders are positioned specifically beneath these structural floors to capture the liquidity released when they break. These retail support levels serve as target zones for algorithms looking to extract high-volume liquidity from forced sellers. Algorithms actively initiate a sudden flush, a rapid downward move specifically designed to pierce the chassis B support floor. This pierce triggers the stop-loss orders of retail participants who entered long positions during the preceding A-wave. The momentum of this break encourages breakout traders to enter new short positions, adding to the downward pressure. These combined forces create a concentrated wave of market sell orders at the base of the B-wave. These market sell orders are absorbed by institutional limit buy blocks resting just below the broken support. This engineered flush provides the volume necessary to fill large institutional inventory blocks with minimal slippage. This completes the refuel cycle, securing inventory before the market begins its next macro expansion. The liquidation sweep facilitates a forced transfer of liquidity from retail stop losses directly into institutional portfolios. We can identify this process through the B-Wave histogram. This tool measures the absorption delta, revealing the hidden interaction between market orders and resting limit bids. As price prints a new structural low, the B-Wave histogram often shows negative bars rapidly shrinking back toward the zero line. This compression signal indicates that the aggressive selling seen on the price chart is being neutralized. During this compression, the histogram will often print high-density absorption blocks. These bright blue dots represent resting limit bids that are absorbing the volume of the panic selling event. Selling velocity effectively drops to zero as these institutional limit orders catch the incoming market sell-side pressure. The B-Wave histogram provides a quantitative record of absorption, showing where limit orders are overriding the momentum of market participants. The execution trigger for this model occurs when the B-Wave histogram fully exhausts its negative compression. This is the polarity shift, marking the transition from negative to positive. This indicates the liquidation sweep has concluded, establishing institutional buy-side inventory. Risk management is defined by the sweep wick minimum, placing an invalidation level exactly one tick below the sweep's low. Entering on the polarity shift allows the trader to align with the institutional position once the accumulation phase is complete. Following entry, the objective is the true C-wave expansion. With liquidity extracted, the market begins a high-velocity rotation out of the accumulation zone. The C-wave targets routine structural highs and the upper H1 and H2 gates as the new trend expansion takes hold. This model positions the trader at the wholesale floor of the cycle, based on the verified exhaustion of the liquidation sweep. Integrating B-Wave telemetry enables participants to monitor the institutional refuel cycle and execute based on limit order absorption rather than price action alone.